Let's talk to Marc Ostwald. He is a strategist at ADMISI. Very good morning to you, young Marc.
Very good morning to you.
Right, as always, you've sent some thoughts-provoking slides to us. Let's kick off without further ado. The 10-year German Bund Italy BTP spread. What is this telling the crowd?
Well, the theme for this week is really about politics and markets. We keep on talking about politics' influence on financial markets. And yet, in both cases, the politics is all a bit crazy at the moment, and market reaction to it is really quite crazy. But let's start off with this one. This is obviously the theme of the day, given that the new Italian government has announced their budget targets after a lot of wrangling. It's going to be a lot higher than was originally planned, which was 0.8. It's going to be a tiny bit higher than this year's deficit, which I think is something worth bearing in mind. You know, it's going to be, what they're planning at the moment is 2.4 as against 2% for 2018.
Right.
So it's not exactly a massive widening, but they will, on the other hand, add to their debt in a very small way. I think the interesting thing is when we look at that Bund BTP spread is really how at every opportunity when the spread has started to widen out, people have taken the first tiny bit of good news about Italy and charged straight back in, which underlines the point that I've made on many occasions,
which you have,
about people being financially repressed. And so that extra yield that you get in Italy is something which attracts people, and everyone's always looking at the possibility that it could be a good rotation trade, and then something like this happens. To be honest, I think this is something of an overreaction. From the aspect that this budget still has to go through Parliament, so at the end of the day, with all the amendments which might be made, the deficit may be as high as 3%, which is not good news. Yes, it's not good news. On the other hand, the relative difference, if it were to be 2.4% relative to 2 this year, is so minimal, it's not really worth talking about. And it certainly doesn't deserve that sort of reaction. I think it's, however, very important because what we've had out of this, one of the big threats coming both from Five Star and the League is if you try and object to our budget, we will start scuppering other things. Which brings me on to the very thorny subject of Brexit negotiations, because that is something which they've already very specifically mentioned, that if the EU goes after them about their budget, then basically the answer to anything in terms of a deal with the UK is no. So the two things are more linked than people think. So let's have a look at some of the things that we've got with the UK. To be honest, here we go. Is there a lot of risk priced into cable? I wouldn't actually say that there is. Again, we've had concerns about how the Brexit negotiations are going, but since about the middle of August, basically any time we get a little bit of good news, everyone sees it as a good reason as a buying opportunity. Now, there are other aspects to this. I mean, obviously, we've got the Conservative Party conference next week, which could see the hard right within the Conservative Party try and unseat Mrs May, which obviously is not going to be good news in terms of how the negotiations go on. But would you say that, I wouldn't say that this chart is telling me that financial markets are particularly concerned, which brings us back to another point about politics and markets. At the moment, the story of the real story with all of this is markets don't actually react to potential political risk only when it crystallizes. So let's have a look at the next chart, which is implied volatility for sterling dollar. 30-day vol, yes, spiking a bit higher, but we're still not back at the levels we were seeing back in February, which is interesting. And 90-day vol, the more traditional measure, really just jobbing a range. I wouldn't exactly say people are rushing to hedge their sterling positions. And in all of this, I think there is another point to be taken on board, and that is particularly relevant in the next two charts that I've got this week, which is the spreads between UK gilts and US Treasuries, which are going to carry on widening. The Fed this week made it very clear it's looking at another rate hike in December. It's looking at 3, if not 4 rate hikes next year.
Yeah, and one the year after.
Yeah, and in the UK, we've got 1 rate hike priced. So this spread, which is already 200 basis points, and so you're thinking, well, at that sort of level, I think I'd rather have the dollars, is going to get wider.
Yep.
So that's basically not a great reason to be holding sterling. If you look at it in terms of the 10-year spread, which is, I think, quite interesting, as much as that's marching resolutely higher, actually the spread here has narrowed a little, which tends to suggest that the 10-year is, the UK 10-year gilt is pricing in a little more risk in terms of Bank of England rate hikes and in terms of what goes on with Brexit, though no one really has a clue what's going to go on there. But again, you're still looking at a spread of something like 147 basis points at the moment, and you really have to ask yourself, other than the argument, I can't have all my eggs in one basket, i.e. in dollars.
Why would you hold sterling?
Why would you hold sterling? And the politics is almost irrelevant in this particular case, but I think as we go into Q4, the Italian budget situation, the Brexit negotiations, and obviously the midterm elections in the United States are going to make politics something which we perhaps have to anticipate more in financial markets in terms of risk, rather than reacting to, oh, we've hit the buffers.
And on that note, young Mark, thank you very much indeed.